The Reserve Bank has increased the repo rate again with 50 basis point. I must say that I didn't expect it. I was expecting maybe they leave it where it was, or if they increase it at least just by 25 basis point only. But I must say I was wrong. So today I want to break down, because of these increases, should we now fix our interest rates, or what then should we do? In this channel, as you know, we talk all things real estate, all things personal finance. So stay with us as we break down this topic of whether we should fix our interest rate or we should keep our interest rate as variable interest rate at this point. So before I go any further to break down whether we should fix our interest rate or not, I think I should first make you understand the terminologies and what it actually means, right? So if we are talking about the repo rate, which is actually short for the repurchase rate, right? So the repurchase rate is the rate or the interest rate of which the Reserve Bank lends money to the banks, like the financial banks that you and I uses. Like we're talking about Standard Bank, we're talking about Nedbank, we're talking about Absa, we're talking about FNB. So all those banks are borrowed money by the Reserve Bank at an interest rate, right? So now those banks borrows us money at a rate also which is called the prime lending rate. So when the repo rate increases, it affects the prime lending rate, right? So those two are proportional to each other, directly proportional to each other. If the one decreases, the other one also decreases. If the other one increases, the one decreases by the same margin, right? So as you know, if you are taking a home loan or a vehicle loan, right, you will have an interest rate that is charged to you, right, of which is the additional money on top of the principal money of which you should repay back to the bank, right? So that interest rate can either be what is called a fixed interest rate or a variable interest rate, right? So what does a fixed interest rate and a variable interest rate mean? So let's break that down to you right now, right? But before we get to that, right, this information that you get from this channel, I mean, it's powerful information, and it's information that helps you to change your life. I mean, don't just keep this information to yourself. I mean, if you have not subscribed already, come on, you know what to do, You know what to do. It's free. Just hit that subscribe button. Don't forget to like and share with your friends, right? So let's now break it down. What is a fixed interest rate and what is a variable interest rate? Okay, so if we are talking about a variable interest rate, right? A variable interest rate is normally the standard when you get a loan, unless if you specify that you want a fixed loan, a fixed interest rate. But in most cases, a variable interest rate is standard because it is assumed to be cheaper on a long term compared to a fixed interest rate, right? So a variable interest rate means that if the repurchase rate increases or it's increased, the fixed the variable interest rate will also increase. If it goes down, the repurchase rate goes down, the variable interest rate also goes down. So it's also directly proportional to each other, right? But what does it mean when it goes up and when it goes down? The interest rate actually just determines the amount of installment that you will pay. So if it goes up, it means your installment also goes up. But if your variable interest rate is going down based on what is happening to the repo rate, then your installment goes down. So it works around that way. So now, as they've increased the repo rate, the prime lending rate by 50 basis point, or the repo rate by 50 basis point, what it means is that so many people installments are becoming higher, which means that people now are struggling to actually afford. In most cases, some people that bought during when the interest rate were very much lower, you know what, they are struggling now, because I mean, there's been so much increases. Like, I mean, maybe now it's 8 or 9 consecutive hikes, which is really not really nice for other people, right? But that is being caused by the inflation, right? So on this economic cycle that we are having now of high inflation, it means things becomes less and less affordable. Most people struggle to keep whatever they have. Some people decide to sell. Okay, so that's what it means by a variable interest rate. So now let's get to a fixed interest rate. A fixed interest rate, it means that it's not directly linked to a repo rate, right? It means when a repo rate increases, your fixed interest rate don't increase, or it doesn't decrease when the repo rate actually reduces. Okay, so it stays whatever it is. Normally, you cannot fix for the whole term on a home loan. Actually, you can fix for a certain period, and then from that period, when it expires, you again redo the fixing again. So that's how it works. Why would a person fix their interest rate? In most cases, you want to fix because you are unsure of the future, right? You just want to be able to sleep at night, that you're comfortable that your costs are gonna remain the same, right? Which one is better between a fixed interest rate and a variable interest rate? Well, everybody's personal finance, it's unique and it's their own personal finance, so it differs from circumstance to circumstance, right? But if we are to compare, a fixed interest rate is a bit higher compared to a variable interest rate on a short term, right? So that's what is important to understand. But now the big question, should you actually fix your interest rate now, because there's so many hikes that has been happening, and maybe we still anticipate more hikes? Does it mean that you must fix your interest rate? Because I mean, now you are struggling, you cannot pay all these things, because now it's not just the increase on your home loan, but it's an increase on every other things, because inflation affects everything. It doesn't just affect one aspect of your life. Then it means the cost of living is very high at this moment in time. So does it mean you must fix your interest rate? So to make you understand this, I would like for you to understand that the economy works in cycles, right? And it's very vital for you to understand the cycles of the economy. So I just don't have enough time here to start with the cycles of the economy. But if I can just summarize it this way. The banks are not a charity organization, right? The banks are in this business to make money. Just like you wake up every day to go make money, not to go and lose money. So in scenarios like this, where every single person can almost predict that the interest rate and the inflation will continue going up, right? And it's almost certain that the repo rate is going to go up. Everybody can predict it. So you as a bank, what do? The bank will not want to risk. They will want to save money as much as you want to save money. So what it means is that in these market conditions, where everybody can almost predict that the repo rate will go up or the interest rate are going to go up, the bank will not give very much favorable fixed interest rates. It means that the fixed interest rate they're going to give will be much more expensive. Right? Will be much more expensive. Then when is the best time to actually fix your home loan? The time that is best to fix your home loan is when almost everybody can predict that the repo rate will go down. Just like when the interest rate was going down, like I think just when we're transitioning from the COVID period. Through that time, everybody could predict, because I mean the lockdown brought the economy to a standstill in a manner that there was no demand for anything really. There was not so much transaction happening. So to stimulate the economy, the government had to reduce the interest rate, right? So that now there can be some market activity and transactions going on now, because that's how the economy runs. So at that point, when they are busy reducing the interest rate, that's actually the best time to fix your interest rate, because at that time the bank is not losing so much money. But now with high inflation, they're losing more, so they will not give you a favorable fixed interest rate. I hope that makes much more sense and it helps you. I don't want to make this video so long, so cheers. I'll see you in the next one, but don't forget to subscribe, don't forget to share with your friends, don't forget to like the video. If there's any question or comments, just go to that comment section and then let me know what you think. Cheers.